SoFi Technologies. Ticker symbol on this one, SOFI. SoFi. $13 and some change stock here today. It's up about 44% year to date. Now, SoFi, you got to understand, is at the cross sections of, I would call it new age banking and fintech. Okay? They're part banking, they're part fintech, they're part tech platform. Okay? So, in regards to SoFi, something very important you got to understand is many investors are underweight on this stock. This is a very attractive retail investor stock, right? And I'm a retail investor, even though I've been in the market 16 years, right? I'm still just a retail investor. I'm underweight this stock. I got to be honest with you guys, okay? I own 3,700 shares in the public count. I want this stock to go down. I really want this stock to go down. I want 5,000 shares in the public count. Like, that's been my goal in regards to SoFi, is get to 5,000 shares, and then I'm good. Like, you know, I wouldn't mind holding 10,000 shares of SoFi in the public count, but if I get to 5,000, I'm good with that. So I'm just one of many people that's hoping this stock goes down, that's waiting for the stock to go down, that's like, please, can the stock go down? I can tell you I'm not the only person. There's a lot of people. And that makes it very difficult for the stock to go down, because people start getting more and more impatient if the stock's not going down, and especially if it just keeps going up. And they're like this thing's never coming down. I better buy shares now, right? And so I've made 97% on the stock, but I'd rather just not have made any money right now. I'd rather the stock be right back at my cost basis, wherever that's at, right? Because I want to add more shares. So it's very important everybody understands that. Now, in regards to SoFi's latest income statement, it was unbelievable. Look at this. Loans and securitizations, $671 million versus $539 million in the same quarter last year. Total interest income, $723 million versus $564 million. Net interest income, NII, which is one of the most important metrics you ever look at in regards to banking-related companies, $431 million versus $344 million, right? But keep in mind, they also had their tech side of the business as well. So if you look at total net revenue, $697 million versus $537, right? And that's just that more fintechy side. That's just not a side you get with traditional banks. And I think that's one of the other reasons SoFi is so attractive, because I think about it and I think about the banking side so attractive because it's just so phenomenal with attracting the new age customers. But then I also think about the tech side, and that's so attractive. And so it's a very special stock, right? Now, if we look here, net income went to $60 million versus a $266 million loss in the same quarter last year. So they flipped to profitability, and that profitability is just going to likely keep pouring in bigger and bigger for at least the next, I would say, year or two. And then we'll see where the economy shakes at longer term and those sorts of things. But things are looking pretty good here in the short term. That's for dang sure. Now, SoFi, I believe, has reached escape velocity. And this is very important to understand this in regards to a stock. When a company reaches escape velocity, the way I would, I would put it like this, okay? There's almost nothing anybody can do to stop the company now at this point in time. And that's the way I look at SoFi. They've got it down to such a science in regards to their marketing and being able to acquire customers in an efficient manner, right? And get those new age customers and get people into the ecosystem of SoFi. They've got that down to perfection now at this point in time. And I don't see that slowing down. The tech side, I see that just continuing to just be at escape velocity and just be gone. And so that's the way I look at SoFi. They've reached that level now at this point in time that there's just really no stopping them, in my personal opinion. There's really no competition to make them stop. You know, the traditional banking companies, they can't do it. The fintech companies, they can't really do it as well because SoFi is so well integrated on the banking side. Because fintechs in general don't want to be banks. And banks don't have the ability to be fintechs. So that's why SoFi is such a special stock, and it's important everybody understands that SoFi is such a special stock because they're really the only company out there that can be a bank and they can also be a fintech. It's not really possible for other companies to do that. And so it's very special, right? Now, I've spoke about SoFi recently in a few videos. I spoke about it, if I recall, I featured it in 6 Stocks to Buy Now, November edition. So I'm not sure if you guys got a chance to see that video, but if you want to hear me talk more about SoFi, check out that one. And additionally, this video from a couple weeks ago, SoFi and PayPal buy, right? That's when SoFi was $10 at that particular time. PayPal was $80. Definitely want to check out that video as well. If you care about SoFi stock, right? That's definitely one. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Alrighty guys, so SoFi, what a move. What a move it's been. Now, let me just say this first and foremost in regards to SoFi. I have some regrets. I regret not getting to that 5,000 shares like I wanted to get to before the move started. I knew I needed to add this one aggressively, and I thought I added it pretty aggressively, but not quite aggressively enough. And it's already started the epic move, obviously, 100% plus move, right? Without me having that 5,000 shares I wanted to have in the public account. Now, I do have shares in my other portfolios as well, so if you add up the total, it's a pretty large number of SoFi shares, but public account specific, I wanted 5,000 shares, and I got 3,700, so I'm about 1,300 shares short of where I wanted to be. Now, it is what it is, right? Do I plan on selling those shares in the public account anytime soon? The answer to that is no. I do not plan on selling my SoFi shares in the public account anytime soon. And I'll run you through the numbers, and we're going to go through that in just a moment, and kind of explain more in detail on why it's just not attractive for me to sell yet in regards to SoFi. If this has some sort of parabolic move over the next year or two, I might feel differently about that. But for now, it just does not make sense at this point in time. Let's go ahead and react to this video, and then we'll start running through valuations, what I'm expecting to happen with the stock moving forward, and all that good stuff.
SoFi's lending business, some of it comes down to earnings. SoFi reported a clean beat and raised quarter in late October. Some of it's because they've made some major partnerships, like a $2 billion deal with Fortress, I love those guys, to expand the lending platform, or team up with BlackRock, another place I love, to create a robo-advisor platform announced earlier this week. So can this thing keep running? Let's check in with Anthony Noto. He is the CEO of SoFi Technologies, longtime friend of the show. To find out, Mr. Noto, welcome back to Mad Money.
Jim, thank you for having us, and thank you for all your support.
Well, what?
You know what I just thought was interesting? Kramer goes, can this thing keep running? Whenever a stock makes a huge move like this has made, right, a double up in a matter of 3 months, people think it's crazy, oh my gosh, that stock's insane, can it really keep this up? This is insane. SoFi was a stock that was held down in a coffin for years. Let's not forget that. Let's not forget that SoFi made tremendous progress in regards to its income statement, its balance sheet, its cash flow, everything. Its customer base over 3 years. And the stock was 6 feet deep in a coffin for years. So you see this move of whoa, it made a 100% move in 3 months, and people are like, whoa, this is wild, man. This is crazy. It's did you miss the fact that it was buried 6 feet deep for year after year after year after year? Did you miss that part, right? So I think that needs to be said.
Let's go over that. The reason I supported you, some of it is because I've known you forever and always think that you're one of the best I've ever met, but also because you had a vision, and the vision was to become more of a service company, but that you were never in doubt, even that people said, listen, your loans must be bad because you don't want to sell them, all that nonsense.
Well, Jim, our goal is to set out to help people achieve financial independence. In order to do that, we have to be a one-stop shop for all their financial services needs, and it takes a while for each one of those businesses to grow. We're not a lender anymore. In the most recent quarter, we reported 49% of our revenue came from non-lending. We grew revenue overall 30% year over year, and it was driven by financial services products and our technology platform, not lending, which was up over 60% year over year.
Okay, so let's go over lending. There were people who came in and said, Jim, these loans must all be bad, and that's why he won't sell them. You stuck by them and said, look, no, we're going to do, we have the cushion, we can do what we want. So who was right, the Bears or the Bulls?
Ultimately...
Wait. Say that again? What?
These loans must all be bad, and that's why
50% year over year.
Okay, so let's go over lending. There were people who came in and said, Jim, these loans must all be bad, and that's why he won't sell them. You stuck by them and said, look, no, we're going to do, we have the cushion, we can do what we want. So who was right, the Bears or the Bulls?
Ultimately, we've delivered results, 17 consecutive quarters of record, 17 of 19 quarters of record revenue. We've had 19 quarters of more than 20% year-over-year growth, and we've continued to diversify the business. At the beginning of the year, we felt we could actually grow the other businesses, not take on much risk, and show that the loans could perform, and they've performed really well. And in fact, credit has improved throughout the year.
Well, I think
this is a ridiculous take. Anybody who's saying, oh, the loans are bad, so that's why Anthony Noto doesn't want to sell them. What? If the loans were bad, if anything, Anthony Noto and the team would want to sell them. Get rid of them at whatever price you can if they were bad loans, right? Like that's insanity. That you would go out of your way to keep loans in your book because they're bad. Like if they were bad, you want to get rid of those things. If they're risky, get rid of them. Sell them for, a quarter on the dollar. Sell them for 40 cents on the dollar. Do whatever you like. That's wild. Like that's just a ridiculous take. Like crazy.
Important to point out that in the last few quarters, things are just getting better and better. The loan delinquency 90-day 0.57 down from 0.64. A charge-off 3.52 down from 3.84.
That was a shocking beat. I mean, the revenue beat. Even as a SoFi bull, I was like, whoa, 689 versus 631. I was even in shock about
major
that one.
When it comes to a delta, the percentage.
Absolutely. Those curves are not easy to bend, but we did it through disciplined credit underwriting standards. We tightened the standards as rates went higher. We increased WAC on the coupons to make sure we had the right risk reward on our loans, and that's why we've had such strong performance.
So talking about the Fortress deal, I think they're very exacting. They don't get involved unless they think that they're going to get their money back. They are probably the shrewdest, I think, of the big private equity companies.
This concept of a loan.
And I love that they beat on EPS as well, because, it'd be one thing if SoFi's just growing for SoFi's sake. Like, let's just grow revenues. Who cares if we make profits? No. Anthony Noto is very focused on that bottom line as well, which I appreciate in a massive way. And that's something that's made me so bullish on the stock over the past year, is seeing that discipline. I wasn't interested in the stock several years ago when it was a company in which, we're going to, just grow. But the bottom line was a miss. It started getting interesting to me really in the past year when I could see that flip happening, where it's like, oh, this is going to become a profitable company, and then it's going to build rapidly.
Platform business where we get paid fees for originating loans for other people that want to buy those loans. It really started as an idea back in 2019. At first, when we declined a loan applicant, we would send them to another partner that would underwrite that loan and we get paid a fee. We've evolved that over time where now when someone applies at SoFi, we can either approve the loan on behalf of somebody else using their credit model, or we can approve the loan and get paid a fee for that loan by our third party. It allows us to monetize things we wouldn't otherwise monetize.
Okay, so talk to me. People say, well, wait, what's going on?
Which helps immensely when it comes to the margins, and guess what else? The bottom line. The net margins of this company. That helps immensely.
With student loans. What is it? They pause the student loans, maybe they're not. I always say to people, look, it's not like that. That's the old days. It's a piece of the puzzle, but it's not the puzzle. Is that a correct view?
It is correct. The student loan refinancing business really got hurt during the pandemic when the student loan moratorium hit, and then rates rose over time. That business is a small piece of our business. It's actually doing quite well, especially as rates come down. People will be able to refinance their federal student loans with a lower cost loan. They also could refinance their own personal student loans at a lower price, just like they would their mortgage. So it's a complement to the business, but it's a very small piece.
Okay, so let's talk about the BlackRock deal. We know that Robo is no longer a moron. Robo is real. And
anybody that thinks like the student loan business is a story in regards to SoFi is just years outdated in regards to this one. That's honestly the number one way you can tell if somebody understands what SoFi does and what the company is do they talk constantly about the student loan business? If they do, then they're very outdated and they don't really they're not up to date at all in what's going on with SoFi. No different than Palantir. You can usually tell if somebody's knows what Palantir's got going on or not if they say the company's a cybersecurity company. Kramer, excuse me. Somebody called it a cybersecurity company recently.
And many times superior. I don't mean to denigrate the human race, but we know there's a lot of stuff that's just repetitive. What will this platform mean for you with BlackRock?
This is an important component to our overall mission. We want to help people get their money right, and we want to be a one-stop shop to do that. Within Invest, we also want to be a one-stop shop, but we want to give our members, our investors, access to asset classes they would not otherwise normally get. Asset classes like IPOs or alternative investments that are typically reserved for high net wealth individual. We're giving the Main Street investor access to IPOs, to alternative assets, which we launched at the beginning of the year. And this week we launched Robos with alternative assets. We originally had 3 Robo accounts that really primarily invested in equities, fixed income, and money market funds. And now we've introduced robo accounts with those assets, plus alternative assets with our partners and BlackRock.
Now, people must like these because I'm looking at a new member additions page of 756,000 in Q3 alone, bringing the total to 9.4 million members, plus 35% year over year. Where are you getting all these people?
Yeah, we're absolutely capturing market share from the broader universe of checking and savings accounts, from other brokerage accounts, but we're also enabling people to invest for the first time. So beginning investors and novice investors, one of the reasons we launched fractional shares was to allow someone to buy something they like Tesla or Apple or NVIDIA, for $1 at a time instead of one share at a time, which is typically for those companies $100 to $203 per share.
Well, we had a question today on our investment club, which you know about, and it was, why should I buy BlackRock? It's $1,000. This is another way to buy some BlackRock.
You could get access to BlackRock's funds. You could also get access to BlackRock stock through fractional shares or these ETFs or robo accounts.
Excellent. Now, the last time I saw you, we also had to talk about the idea that you had to issue some stock, but it wasn't dilutive. People thought it was dilutive. There were analysts who got it wrong. There were analysts who were betting against you. The stock got hit. It was part of a convert. Where is that? And do you have to do any more of that kind of issuance?
No, we're in really good shape. We were able to capture some opportunity to refinance at a point in time where it was attractive to investors and attractive to us, but we're well capitalized now, and our 3-year plan that we laid out at the beginning of the year, we're well on track to achieve that. And last quarter's results was further evidence that we'll deliver on 2025 and 2026, barring any unforeseen circumstances.
Excellent. I can't have you leave without asking you, I hate that it's Veterans Day. Okay, my dad always said, why isn't it Veterans Year? I mean, it sacrificed a lot as a sergeant, all that. I always think of you in the Army. Congratulations so far for Army. What are you doing for veterans? Because you know veterans and their issues more than anyone.
Yeah, we are very focused on helping people from a mental standpoint and have mental health. It's an important cause that we have focused on that obviously pertains to veterans as well. We also employ veterans, and we have inside SoFi, we have a group which we call Stripes as an affinity group for veterans. Obviously, it's very near and dear to my heart, having served, but I thank all those that are out there putting their lives on the line for democracy. And we're in a very uncertain time today on 3 different fronts. We could face very challenging times. So our message goes out to them. Thank you for your service and defending our country.
Well, thank you so much for coming here and saying those things. Thank you for being, of course, a man of your word, which I of course, never doubted, as you know. But there were plenty of people who said, well, I don't know, Jim. I do know. And what we saw today, and we listened to you, and what we saw with these deals with BlackRock and Fortress, 2 of the best, all deserving for you. Thank you for sticking with it.
Jim, thank you. We're just getting started. Some more to come.
I think you are. It's Anthony Doe. He's SoFi Technology CEO. We told you. Man Money's back after the break.
So I actually really like this person's comment right here. For the first time in a long time, a Noto interview with only positive vibes. Normally he's defending himself the convertible debt offering. Also around student loan repayments and the adverse stock reaction, those sorts of things. Yeah, that's a really good comment. And I got to say, I definitely agree with that. And we're about to get into valuation in regards to SoFi, what's a good price for the stock, where the stock's going. But in regards to Anthony Noto, 100%. That's a very good comment. Yeah, that's the most at peace I've seen Anthony Noto in years of watching those interviews, right? And here's why. 1, the business is doing well. 2, the stock is doing well. And when the business is doing well and the stock's doing well, it puts a lot of concerns to ease. You also could have said the same thing about Alex Karp, Palantir CEO, right? Definitely, I think, much more on the defensive and very kind of a little more combative if we look back 2-3 years ago, versus if we look now, Karp is much more in control and feeling good about things and whatnot, right? He's still passionate and he still gets fired up, but it's from a different angle than maybe it was 2 or 3 years ago. Yeah, I mean, at the end of the day, Palantir stock was a $6-7 stock a couple of years ago, right? And now it's a $60 stock. So that alleviates a lot of pressure. It makes you feel a lot better as CEO, the captain of the ship, right? Same thing with Anthony Noto here at SoFi. SoFi just a few months ago was a $6-7 stock. And so now as 14 plus, that alleviates a lot of pressure. Come through with a banger earnings, the stock prices reward it, and you start to feel a little bit better and a little bit more at ease and a little bit more calm in regards to the situation. So definitely no doubt about that, okay? Now, looking at 1000xstocks.com here, looking at a few things in regards to SoFi, there's definitely some things I like, right? First is, I love when I can see this trend likely transpiring. A trailing 12-month PE goes a lot lower when it comes to forward P and much lower again for a 2-year out forward P. Keep in mind, analysts are probably too low on their estimates for that 2-year, so there's a decent probability that 2-year forward P might be in the 30s for the stock. But this is what I love to see. The company's expect to get much, much more profitable over the next year, over the next 2 years, right? Additionally, we look at trailing 12-month revenue growth, 27+%. We look at current year expected revenue growth, 21+%, right? Next year revenue growth, analysts have gone some very bearish. I don't know. Like, based upon the numbers the company's putting up, I think there's a pretty good probability they're gonna be 20% plus revenue growth when it comes to that, right? So that's something to keep in mind here. 2-year stack expected revenue growth of around 34%. Like I said, I think analysts are too low in regards to their numbers there, right? Now, next up here, take a look at the trend in regards to this company's revenues, right? Very, very impressive. But this is on a quarterly basis. I love to see it over a trailing 12-month basis because I think it gives you a better context of what's actually going on with the business model, because we know sometimes quarters can be up, down, all those sorts of things. Check this out. Trailing 12-month basis. Is that not amazing? Like, I love this trend for SoFi. And in my opinion, the revenues are just going to keep going higher and higher. And it's very, very impressive. And then we got the earnings per share coming along. We had a very red earnings per share. Now it's a very green earnings per share. That's phenomenal. That's exactly the trend I want to see in regards to a financial institution like SoFi, right? Now, here's some numbers I ran in regards to SoFi so you can understand kind of what I think could be a realistic scenario. I would call this kind of like a base case around SoFi. And I didn't want to average the numbers here for SoFi. Usually I just kind of average a revenue growth rate. I think it's going to be the average over the next 4 years and average net income. But instead of doing that, I said, let me go ahead and do what I actually think they're going to do per year. And the reason being is because their net income is going to be up so immensely in 2025. There's a good probability that their net income's up somewhere between 100% and 150% next year. And the reason being is they just started reaching, profitability in regards to bottom line. So usually you see thousands of percent a gain or hundreds of percent a gain of net income over those next few years, right? So I have been doing 20% revenue growth in 2025, which is actually significantly under what they have been doing. And then I have them doing about 125% net income growth in 2025, right? I have them doing 17% revenue growth in 2026 and 55% net income growth in 2026. That puts them at about $3.6 billion of revenue and $418 million of net income. 2027, I have them doing about $4.1 billion of revenue, 15% growth there, 35% growth in the bottom line. And then basically I kind of thinking about the company as like a 15%-ish grower after that point in time, which puts you at about $4.7 billion of revenue in 2028, a little over $700 million of net income 2028, right? Now, I had the P's coming down as the growth slows over the coming years. So right now you might be willing to pay like a 90 to 120 P for that, which is right where the stock is right now, right? It's a $14 stock, so it's roughly in that range. But as the growth rates slow over the coming years, right, you're going to pay a little less P. So you might be willing to pay like a 75 to 95 next year for it, right? Which puts the stock somewhere between $21 and $26 next year. Then 2026, you can say growth keeps slowing. Maybe you're willing to pay a 55 to a 65 P then at that point in time, which puts the stock somewhere between $24 and $28 in 2026, which gives it a pretty amazing compound annual growth rate of 28% on the low end, 39% on the high end, right? Growth slows some more, so then you might be willing to pay a 45 to 55 P for the stock, which puts the stock somewhere between $26 and $32 in 2027, 22% CAGR on the low end, 30% on the high end. And then let's say growth keeps decelerating there. You may be willing to pay a 35, 45 because this is a fintech / bank, right? New age bank that's got 15% growth top line, 25% growth in bottom line. Probably willing to pay a 35 to 45 PE, puts the stock 25 to maybe 33 in that particular year. Compound annual growth rate on the low end, 15%, 23% on the high end. Do keep in mind, SoFi could come out with new game-changing products and services over the next few years, which could, accelerate growth rates. But you don't want to bank on that. You don't want to bank on we're going to come out with this next massive product, service, or things like that, right? You just want to kind of more bank on just kind of growth decelerates over coming years, right? So the moral of the story is the compound annual growth rate looks pretty darn attractive in regards to SoFi, right? Now, there is always the risk of eventually a big recession coming. And when I say big recession, it would be an unemployment recession, right? So in the short term, doesn't look super probable in regards to that. 2026, who knows? Like 2027, who knows? 2028, who knows? Like that's just throwing darts at the dartboard, right? And trying to predict recession several years out. That could always be a situation. It might not be a situation. We don't know, right? But it seems like Anthony Noto is also putting the company in a very good position from kind of a financial stability standpoint as well. And he's staying very disciplined with the business model. And so for that reason, I think SoFi will gather more respect over time. And also, I think as a fintech side of SoFi is understood better in all the services and fees they're going to be making, right? I think as that business is understood better than just the traditional banking front, I think this company should command definitely a big premium over the market. So, like, let's say, for instance, I have a 35, 45 PE here. That might not be realistic. They might command a much higher P than that. Because people will view this as this is the new age bank. It's attracting all the millennials, the Gen Z, the Gen Alphas, right? And people will view this as, oh my gosh, like this company's just going to keep growing like a weed for potentially decades to go in the future, right? And so if that's the situation, you're willing to pay, Tesla-like multiples, Palantir-like multiples for a company like that, right? And then if they understand the fintech side better, they're also willing to pay much bigger multiples because we know banks trade at bad multiples. Like banks trade at very bad multiples.